We are taking stock of markets, which are still up about 20 points or so off the highs by a significant degree. The big one, of course, is oil, the sharp drop that we saw overnight. And people are wondering whether we are now we're going to start to see another big round of downside in oil, or what we saw overnight, that big 7% plus fall, was a one-off. Manisha is here with just that. Manisha, morning.
Morning, Prashant. Thank you so much for that. Well, the volatility in crude oil prices just about continues. Well, yes, 7 to 8% of a cut in case of Brent and US crude is what we have witnessed overnight. 0.5% up in the Asian markets right now, but that is clearly some bit of a buying after such sharp correction that we saw overnight. The concerns are still on. Ahead of the Fed Fed meeting announcement, we also have seen the volumes decline a bit. But what really has been bothering the crude oil prices for some days now really has been the supply issue. Record high output continuing from US, from Russia, from Saudi Arabia, and the output cuts only will start from 1st of Jan. So in December, all of these big producer countries are still churning out record production. That is, of course, one part of it. The other is the demand concerns that we have seen come in from Asia and from Europe. Also, the expectation from major oil producers or major oil experts now is that in 2019, the demand growth will be less than what we have seen in 2018. That's yet another one. And then there is, of course, just so much to watch out for. You have the Iran sanction waivers that will play out in some sense. You also are looking at the new projects that would come in 2019 from US. There is a definite number out for that as well. And then it is also going to be about the OPEC and allies review meeting in the month of April. So the first half of 2019 itself has so many events that the markets do believe that it is going to be a very volatile year to start with in sense of that as well. But joining us now is Edward Morse from Citi with his sense on what really can be expected in case of the crude oil prices. Ed, hi, pleasure having you on the show. What is your sense on the kind of decline that we have seen in the crude oil prices overnight? What do you give that to? Is it really about the speculative money going out, or the markets really are unwinding positions as we get into the holiday season?
There are several factors at work. One of them is the new U.S. report on productivity of oil shale, which looks like the thrust upward of production is going to continue. Another is the Saudi budget report, which indicates that Saudi Arabia expects oil prices to be averaging a higher level to allow them to balance their budget at above $80 a barrel, and the world finds that fairly implausible. So it's kind of like pie in the sky thinking, and there's other factors in the market that are affecting the equity markets, and with the oil market. So I think from a fundamentals perspective, the market is a little bit more tightly balanced than what the fallen oil prices indicated. I would not be surprised if there were a bounce up, but undoubtedly the long-term trend is for a significant oversupply on the oil side, and not enough credible cuts by the OPEC Plus group to balance the market.
Ed, so a couple of points that you mentioned. One, of course, is the 23% increase in the crude output from U.S. in this year. And the U.S. shale output is expected to increase to 8 million barrels per day, a record high in itself. What is your sense? How bearish a factor is that? But also with the crude oil prices now slipping to around 45 and 55 kind of level, how price sensitive are the U.S. shale output producers going to be on this?
I actually think the shale production growth is the most important of all the supply factors that are impacting markets today. Nobody had expected that U.S. production was going to grow as rapidly as it has as a result of the high prices that we've seen in the third quarter. U.S. production is continuing to rise at over 2 million barrels a day annualized. The costs of production continue to fall. And it's clear that the OPEC Plus countries, since 2014, have followed strategies to gain market share against U.S. shale that have failed one after the other. And it looks like what I call Act 3 in the OPEC Plus group, in terms of trying to make room for themselves and to shut out shale, is likely to fail in the same way that the other parts of their efforts have been since 2014. So people in OPEC Plus countries are looking to see that or believing that the reduction in capital spending is creating a supply gap, and that supply gap is not materializing, and it's not materializing largely because shale is increasingly responsive at lower and lower break-even prices. We now are seeing that even at a $55 price, U.S. production can grow sustainably by over 1 million barrels a day. The sector has seen a radical change in who is doing the drilling. The majors, the super majors, have moved into the shale. Exxon, Chevron are two of the 3 largest drillers in U.S. shale, and they're drilling in order to build up production of oil, natural gas, and natural gas liquids, and they don't care about the near-term price. So that's a very new factor in the market, and it's something that the OPEC Plus countries have not yet come to grips with.
Well, that point is well taken. But Ed, with nearly 35 to 37% off now from its October highs in case of crude oil prices at a 15-month lows, what is your sense? Are the prices going to stay here, or do you see a rebound once we get into 2019?
I actually don't think so. I think what is sustainable is a higher price. We are in an environment in which I think $60 is Brent is the normal price. It's a price that allows production to continue to grow. But we also have incredible price volatility because there are so many other factors that impact supply and demand balances, including global GDP growth. We're in a volatile price environment that has seen $20 to $25 spreads in the range of prices over the last 5 years. I don't think that's going to change. So if 60 is the new norm, that means we're going to see prices at 75 as a soft ceiling, 45 as a soft floor, and it's going to be quite volatile within that range. So, no, I don't think 56 or 55 is sustainable. 60 is probably sustainable, but the market doesn't look for one price. The market is responsive to financial flows that take into account global GDP growth, global trade growth, and expectations about a lot of things that bring the price either lower or higher than that $60 a barrel. At the moment, we have come out of an environment in which the market feared that there might be disruptions from supply from Venezuela, Nigeria, Libya, Iran, Iraq that overwhelmed whatever the supply response is from unconventional oil, including shale and deep water. And now we're at a moment where the market expects that we're not seeing those disruptions in supply. Disruption risk has disappeared from the horizon in the market for the time being. It's going to reappear at some point. And the market is focusing on the U.S.-China trade war, the prospects for lower GDP growth, the prospects for lower demand growth, and with that higher production, so a surplus and a build in inventory, and the market has become bearish.
Ed, most people seem to believe that we will see 60 of an average in the first half and 70 perhaps in the second half of 2019. What is your sense? Where do you see the crude oil prices averaging for the whole of next year?
We're thinking the average is going to be around $60 a barrel, with the end of the year at around that level, but the middle of the year going lower in the 50s than it currently is. So that's in the sum, where we think the market is. It'll get stronger through the first quarter if the fundamentals work out the way that we think they are. Weaker into the second quarter with supply growth continuing from the shale side. A little bit better economy toward the end of the year with a higher demand for distillates in pulling the price of crude up, getting us back to the high 50s or low 60s by the end of the year.
Okay, all right, Manisha, as well as Edward, thanks very much for joining in and taking us through that conversation. So $60 per barrel would probably be a more sustainable level according to City Research with regards to Brent crude prices, currently at around $56.6. Need to take a break with the news that the mid-cap index is up 1%, Nifty sustaining at those levels of around 10,940.